imagine looking at a stock chart, right? And you see a company that is up like a staggering 228% over the past 52 weeks.
You'd naturally assume they cured aging.
Right. Or, invented a perpetual motion machine or something. But if you change your chart timeline for their exact same company to just this calendar year-like,
Right.
just year to date, it is down nearly 21%.
Which is just a wild swing.
It's crazy. Welcome to the pitch dark roller coaster of biotech investing. And welcome to our deep dive on Omeros Corporation. Today, we are unpacking this massive paradox for you.
Yeah, it's a fascinating one.
We've got a dramatic recent earnings beat to dissect, the launch of their high-priced orphan drug, YARDEMLEA, and honestly, a whole lot of regulatory tension.
A ton of it.
Right. So our mission today is to figure out if their massive Q2 revenue beat signals a true fundamental turnaround. Or, this is just a temporary, unsustainable spike before the roller coaster drops again.
The sheer volatility of this particular stock is, well, it's a perfect case study of how the market really struggles to price innovation when there are, extreme variables at play.
Oh, absolutely.
We are looking at a company that is simultaneously executing a highly successful commercial launch in the US while also facing this kind of existential regulatory threat overseas.
Right, pulling it in two completely different directions.
Exactly. Those two forces are pulling the valuation in opposite directions, which explains the whiplash you see in the stock price depending on, exactly when you bought in.
Well, let's start with the catalyst that caused the massive upward jolt just recently. This was on August 12, 2026.
The Q2 earnings.
Right, the Q2 earnings. The numbers sent absolute shockwaves through the analyst community. The consensus estimate going into that report was that Omeros would post a loss. They were modeling an adjusted earnings per share of negative 27 cents.
Which, to be fair, is the baseline expectation for a biotech company in this specific phase of commercialization.
Right, burning cash.
Yeah, the assumption is always that they're just burning through their cash reserves to fund really aggressive marketing and sales efforts.
But instead, they reported a positive EPS of 2 cents.
Yeah.
That is a 107.4% surprise to the upside. And the top-line revenue just completely crushed expectations, too.
It wasn't even close.
No. Wall Street was modeling for about $12.7 million in revenue. Omeros delivered $28.5 million. They didn't just beat the estimate, they effectively doubled it.
And the most important part of that beat is where the money came from.
Right, because looking through our sources, that cash didn't come from like a licensing deal or some weird one-off payment.
No, it came from a dramatic sequential acceleration in sales of their flagship drug.
YARDEMLEA.
Exactly. In Q1, which was its launch quarter, it did about $11.1 million in gross sales. So leaping to over $28 million in a single quarter is a blistering adoption rate.
It's massive. And to understand why the revenue is scaling so aggressively, we really have to look at the underlying biology of what YARDEMLEA actually treats.
Right, because this is definitely not a general population drug.
No. The generic name is narsoplimab, and it is an orphan drug. It's the first and only FDA-approved treatment for a very specific, often fatal condition called TATMA.
Which stands for transplant-associated thrombotic microangiopathy.
Let's actually unpack the biology of TATMA for a second for the listener, because understanding the disease is really crucial to understanding the company's valuation later on.
It's the whole foundation.
So when a patient gets a hematopoietic stem cell transplant, usually to treat a severe blood cancer like leukemia, they go through intense chemotherapy or radiation first.
Right, to wipe out the diseased bone marrow.
Exactly. Then they get the new donor stem cells. But sometimes that intense conditioning regimen, or even the new immune system itself, severely damages the endothelial cells.
And those are the cells lining the inside of the patient's blood vessels.
Right. And that damages the trigger, right?
Yeah, exactly. When those blood vessel walls are injured, the body's immune system basically panics. Specifically, a part of it called the complement system just kicks into overdrive.
Which is usually a good thing, right? Like fighting off infections?
Normally, yes. The complement system is this ancient part of our immune defense. It's a cascade of proteins designed to attack pathogens. But in TATMA, a specific pathway within this system, the lectin pathway, gets hyperactivated.
Oh, gotcha.
An enzyme called MASP2 drives this pathway, causing widespread inflammation and, critically, the formation of these microscopic blood clots throughout the body's small blood vessels.
Like sludge in the pipes.
Exactly like sludge in the pipes. It starves the major organs of oxygen and leads to multi-organ failure.
And this is where YARDEMLEA steps in. It's a targeted MASP2 inhibitor.
Yes.
So it basically binds to that specific enzyme and effectively hits the kill switch on the lectin pathway.
That's a great way to put it. It stops the complement system from overreacting, halts the microclots, and just gives the blood vessels a chance to heal.
And because it targets such a specific and rare biological mechanism, the economics of producing and selling it are entirely divorced from traditional medicine. I mean, the trailing 12-month gross margin for Omeros right now is 94.07%.
Which is staggering. A 94% gross margin means that for every dollar they invoice, 94 cents is gross profit before accounting for their operating expenses.
Basically, the manufacturing cost is negligible compared to what they charge for it.
Exactly. This is driven entirely by the pricing power inherent in orphan drugs, where the patient population is incredibly small, but the medical necessity is absolute.
Right.
Yartamlia is aggressively priced. A single course of treatment runs somewhere between $288,000 and $360,000.
See, and that price tag introduces massive structural friction into their business model. When I look at a $360,000 invoice, I view this less like a traditional transaction and more like a high-stakes hostage negotiation.
It really is.
I mean, think about it. The hospital is holding the patient whose life is on the line, the pharmaceutical company is holding the cure, and the insurance provider, or Medicare, is sitting across the table with the briefcase full of cash.
And if the payer blinks or refuses to open the briefcase, the whole deal falls apart.
Right. A hospital pharmacy director cannot simply absorb a $360,000 loss if the claim gets denied. So, doesn't an astronomical price tag like that inherently stifle widespread adoption, no matter how good the science actually is?
Well, in a purely free market scenario, it absolutely would stifle adoption. The financial risk to the hospital would just be too catastrophic.
Yeah.
But the government actually actively intervenes here to artificially lubricate this exact transaction. The Centers for Medicare and Medicaid Services, CMS, recognize this exact bottleneck.
Ah, right. The NTAP status.
Yes. On August 3, 2026, CMS granted Yartamlia a new technology add-on payment status, which is commonly referred to as NTAP.
And the mechanics of NTAP are fascinating and honestly crucial for anyone analyzing this stock.
They really are.
Because normally, Medicare pays hospitals a fixed, flat rate for a patient's stay based on their diagnosis, right? A diagnosis-related group, or DRG.
Right, a lump sum.
So if a patient is in for a stem cell transplant, the hospital gets that flat fee. If the patient suddenly develops TA-TMA and requires a $360,000 drug, the hospital's costs instantly blow past the payout.
They'd lose massive amounts of money treating that patient.
But NTAP changes that math entirely.
It serves as a financial safety valve. Starting October 1st, 2026, the NTAP status dictates that Medicare will provide additional payments on top of the standard rate to help cover the cost of the new technology.
So how much are we talking?
In the case of Yartamlia, Medicare will reimburse the hospital for up to roughly $287,000 per qualifying patient.
Wow. So Medicare is essentially stepping in and footing the vast majority of the bill.
Exactly.
And when you pair that NTAP reimbursement with the dedicated J-code that went into effect on July 1st, which standardizes all that complex medical billing paperwork, you remove almost all of the financial and administrative terror for the hospital administrators.
That's the key. When a physician orders Yartamlia now, the finance department doesn't have to panic about bankruptcy.
The government is basically paving a smooth runway for adoption. And simultaneously, the competitive landscape has shifted dramatically in Omeros' favor.
Whoa, this was a massive plot twist.
Yeah, just 2 weeks before Omeros reported their massive earnings beat, their primary competitor, AstraZeneca, experienced a major clinical failure.
Right.
On July 27, AstraZeneca announced that their phase 3 trial for a drug targeting a very similar indication, HSCT-TMA, failed to meet its primary endpoints.
And their approach was different, right? AstraZeneca was targeting a downstream complement protein called C5, whereas Omeros targets MASP2 upstream.
Right. And the failure of that C5 approach essentially cleared the chessboard. Omeros isn't just the first FDA-approved treatment anymore. They were the only viable approved targeted therapy on the horizon.
Which is why the analysts at H.C. Wainwright looked at this cleared competitive field, saw the Medicare tailwinds, and immediately reiterated a buy rating on the stock.
Yeah, but, and this is a big but a cleared field, is highly advantageous, sure, but we have to look closely at the actual market ceilings here.
Yes. This is where the underlying tension of the stock price really becomes apparent.
Right, because if Omeros has an effective monopoly on a life-saving drug, incredible margins, massive earnings beats, and the government covering the cost, why is the stock down 21% this year?
It's the reality of clinical behavior. It paints a much more restrictive picture than the headline numbers
Right,
suggest.
because having an FDA approval doesn't mean doctors are legally obligated to use your drug first.
Exactly. TA-TMA is an incredibly niche market to begin with, but it's also highly fragmented and systematically underdiagnosed.
And even when a physician makes the correct diagnosis, our sources indicate that they are not reaching for the $360,000 Yardimlia right away.
No, the clinical habit is to rely on off-label alternatives first. Physicians have decades of experience using cheaper, older immunosuppressants or therapies like rituximab or defibrotide.
Even though those weren't designed for TATMA.
Right. They were not designed or approved specifically for it, but they have shown anecdotal efficacy over the years. Clinicians are comfortable with them, and more importantly, they're significantly cheaper.
Which means Yardimlia is being relegated to what the medical community calls a salvage therapy.
Yeah.
And a salvage therapy is essentially the medical equivalent of breaking the glass in case of emergency. The doctors try the cheap, familiar off-label drugs first. If the patient fails to respond and is actively deteriorating, only then do they authorize the Yardimlia.
It's a last resort.
And when your product is positioned exclusively as a last resort within a patient population that is already microscopic, you hit a very hard mathematical ceiling on your potential revenue.
And the financial models absolutely reflect this restriction. Analysts project that the absolute peak sales for Yartemlea in the United States will top out between $200 million and $300 million annually.
That $300 million ceiling is where the valuation multiples for Omeros start to look, well, completely detached from reality.
Very stretched.
The company currently has a market capitalization of roughly $943 million. So they are hovering near $1 billion valuation, but they're trading at a trailing price-to-sales ratio of 95.33.
Which means investors are paying over $95 for every single dollar of sales the company has generated over the past 12 months.
It's wild. And they also have a price-to-book ratio approaching 46.
Multiples that extreme imply that the market is pricing in flawless execution and massive future growth that goes well beyond that $300 million U.S. cap for Yardimlea.
Right.
Now, a casual observer might look at their Q1 2026 financial statements and think, oh, the valuation is justified, because Omeros reported a net income of $56.1 million for that quarter, which calculates to a net profit margin of 566%.
Right. Hold on. We have to clarify that Q1 net margin immediately, because a 566% margin is a total accounting mirage.
Completely.
That $56.1 million in profit did not come from selling more drugs. It was heavily distorted by a $73.1 million non-cash mark-to-market gain on their 2029 convertible notes.
Yeah, let's explain how this works for the listener. Omeros has debt in the form of convertible bonds. Because interest rates or market conditions changed, the theoretical open market value of that debt went down.
Right.
Standard accounting rules require the company to record that change in debt value as a gain on their income statement.
But it is entirely a paper profit. No actual cash changed hands, and has absolutely nothing to do with their core operating business of selling therapeutics.
None. When you strip out that accounting quirk, the real operating business is still losing money as they scale up their sales force.
So if the current business tops out at $300 million and the profits are an accounting illusion, the only way to justify a $1 billion market cap is to look at the pipeline.
You have to look forward.
Investors are paying a massive premium for the future scientific assets Omeros is developing. And they do have a deep bench of clinical programs. There's OMS 1029, which is a longer-acting version of a MASP2 inhibitor.
Yep.
They have OMS 527, which is a PD-7 inhibitor targeting addiction and movement disorders. They have a cellular therapy platform called TCAT and an oncology program called OncodoX AML.
And, I mean, the science behind those pipeline assets is compelling, but the financial analysts point out a severe structural risk here, and that's timing.
Timing.
Yeah. There are no major near-term clinical catalysts expected for any of these pipeline programs. We aren't anticipating any pivotal trial data or FDA decisions on these assets in the immediate future.
So investors are basically sitting on a highly leveraged valuation, waiting for scientific validation that might not arrive until 2027 or 2028.
Exactly. If Yartamaleya sales stumble even slightly, or if the pipeline hits a regulatory delay, there's just no fundamental floor to catch the stock price.
The valuation is suspended entirely on future expectations.
Which is why a significant portion of the analyst community maintains a cautious hold rating. The risk of a severe correction is just as high as the potential for upside.
Right. And given the hard cap in the U.S. and the long timeline for the pipeline, the company's only viable near-term lever for massive growth is international commercialization.
They have to take Yartamaleya overseas.
They have to. Which brings us to the European market, which is currently the single largest source of volatility and tension surrounding Omeros.
It's the wild card.
Total wildcard. To sell a pharmaceutical in Europe, a company must secure approval from the European Medicines Agency, the EMA. Omeros submitted their application, but the visibility into that process is incredibly murky.
Yeah, we are seeing directly conflicting narratives playing out in real time here.
Right. One analyst report explicitly references a, quote, negative EMA opinion regarding Yartemela, suggesting the regulators are pushing back on the clinical data.
And the EMA often does have different evidentiary standards than the FDA, particularly regarding single-arm trials or, the specific endpoints used in orphan diseases.
But if you cross-reference that negative analyst chatter with the company's legally binding SEC filings, Omeros states that the application is still actively under review,
Right.
with a decision expected by mid-2026, which, could potentially bleed into the third quarter.
And this pending EMA decision is the ultimate binary event for the company's valuation. If the EMA grants a positive opinion, Omeros suddenly unlocks the entire European Union.
Massive market.
Huge. It also paves the way for lucrative ex-US partnerships, where a global pharmaceutical giant might pay Omeros hundreds of millions in upfront cash just for the rights to distribute the drug internationally.
But if the EMA reject the application, Omeros is permanently trapped under that $300 million ceiling in the U.S.
And their billion-dollar market cap will likely collapse.
The market hates uncertainty, which is why the stock has trended downward year to date. However, analyzing the behavior of the people inside the company reveals a fascinating counter-narrative.
The insider buying.
The insider flow, yeah. The buying and selling of stock by executives and board members is sending a massively bullish signal. Over the past 90 days, management and insiders have purchased a net total of over 1.3 million shares.
Wow.
We're looking at 11 separate buy transactions compared to only 2 sells.
That's a huge ratio.
This dynamic reminds me of observing a ship from the shoreline. The analysts on the beach are looking at the horizon, pointing at the dark clouds of the EMA decision, and screaming that a storm is coming.
Right.
But the captain of the ship and all the officers who actually see the daily operations and communications with the regulators are taking their own personal wealth and buying more cargo space on the vessel.
That's a great analogy.
It forces you to decide who to trust, The analysts pointing out the structural risks, or the insiders who rarely buy in this kind of volume if they believe a catastrophic regulatory rejection is imminent.
And it's worth noting, the insider buying is also happening from a position of profound balance sheet strength, which alters the risk profile too.
Oh, definitely.
Omeros is not a desperate biotech company running on fumes. In November 2025, they executed a strategic deal with Novo Nordisk to sell off a different asset called zaltenibart.
That single transaction injected $240 million in upfront cash into the company.
It completely fortified their runway. As of March 2026, Omeros reported $135.3 million in cash and short-term investments. They completely paid off their 2026 convertible notes, leaving only those 2029 notes remaining on the debt schedule.
And management is openly projecting that, based on the current trajectory of Yartemela in the U.S., the company will be entirely cash flow positive within 18 months.
Which is huge. The strength of that balance sheet means that even if the European regulators issue a rejection, Omeros will not go bankrupt. They have the capital to continue operating, to fund their pipeline, and maximize the U.S. market. The stock price would suffer a severe contraction, obviously, because the international growth premium would evaporate. But the underlying company is financially secure.
So, synthesizing all of these conflicting forces, we're looking at a classic biotech tug of war. On the bullish side of the rope, you have a commercial launch that is genuinely accelerating.
Yes.
The October 1st Medicare NT-TAP rollout is a massive structural tailwind that eliminates the hospital's financial friction. AstraZeneca's failure removed the primary competitor, and the insiders are aggressively buying shares.
But pulling relentlessly on the bearish side of the rope is the reality of clinician behavior.
Yeah.
The drug is confined to a salvage therapy role in a microscopically small, underdiagnosed market. The valuation multiples are stretched to their absolute limits based on a clinical pipeline that won't deliver near-term news.
Right.
And hanging over everything is that unresolved binary threat of the European regulatory decision.
So if you were tracking this stock and want to know which side of the rope is winning, you have 3 specific mile markers to watch. First, look at the upcoming Q3 earnings report.
To see if it holds up.
Right. To prove that the Q2 shockwave wasn't just a temporary pipeline fill or a one-time fluke, Yard-Malia revenue needs to cleanly break above the $30 million mark.
Absolutely.
Second, monitor hospital adoption rates after the October 1st NTEPI policy goes live. See if that Medicare funding actually changes how quickly doctors prescribe the drug.
Yeah.
And finally, watch the regulatory wire closely for the OMER decision, because that is the linchpin that will dictate the company's ceiling for the next decade.
It's honestly a masterclass in how complex medical innovation intersects with market mechanics and government policy.
It really is.
Yeah.
But before we wrap up this deep dive, I want to step away from the stock charts, the price-to-sales ratios, and all the regulatory filings, and leave you with a broader philosophical concept to mull over.
Okay, I like it.
Throughout this analysis, we discussed a medical breakthrough that costs roughly $360,000. Yard-Malia is a targeted, life-saving innovation for patients who have already survived a grueling stem cell transplant, only to be hit with a secondary, fatal complication where their own blood vessels begin to clot.
It's terrifying.
The science behind it is nothing short of miraculous.
Yet the reality of the healthcare system forces a very harsh compromise.
Exactly that. Because of that extreme price tag, the medical community actively avoids using the innovation until it is absolutely necessary. They try the older, cheaper, less targeted drugs first.
Right.
They reserve the miracle cure as a salvage therapy, a desperate last resort when the patient is already failing. So it raises a difficult question about the ultimate utility of our scientific advancements.
It really does.
If a company engineers a brilliant life-saving cure, but prices it so aggressively that the healthcare ecosystem fundamentally resists using it until the patient is out of all other options, does that extreme pricing model inherently limit the true impact of the innovation?
It challenges us to consider where the line is drawn, between incentivizing the development of orphan drugs through high profit margins and ensuring those drugs can actually be deployed proactively rather than just reactively.
It's a profound friction point between the economics of pharmaceutical development, the realities of payer resistance, and the fundamental question of who actually gets to benefit when these medical breakthroughs hit the market.
Definitely.
It's something worth thinking about the next time you see a massive valuation placed on a new therapy. Thank you so much for joining us on this deep dive. Keep your eyes on the data, stay curious, and we will catch you next time.